The federal government shutdown continues, and we know that the impact that a government shutdown has on the economy is limited, but certainly there's no ideal time for a government shutdown. And this comes at a pretty difficult time for Federal Reserve monetary policymakers as they will be meeting early next week, and they make decisions about interest rates based on jobs numbers as well as inflation numbers, both of which they don't have. So, how are policymakers to approach addressing interest rates when they don't have that up to date data?
That's right. This is a sensitive time because the Fed cut rates in September for the first time this year. They're widely anticipated to do so again next week. But for a Fed that prides itself on being very data dependent, you're right, there hasn't been data coming in. Now, that is actually about to change. Tomorrow, we are going to get the delayed September CPI report. So that's going to be some important inflation data. They actually had to call some workers back from furlough to put this together. It's viewed as a more essential task because the September reading factors into the annual Social Security cost of living adjustment. So the Fed actually will have updated, albeit delayed, inflation data. The September jobs report has not been released. It was virtually done though before the shutdown. So there is some speculation that maybe with a wink and a nod, some of that info got passed along to the Fed. The base case, though, in the absence of anything to change this idea, is that we will get another quarter point cut next week, probably another one in December as well. That one's written a little more in pencil, but it does seem that we could be finishing 2025 with a series of cuts.
You mentioned that there will, of course, be this report that is eventually released. Will we expect the same level of accuracy despite the fact that workers were, of course, temporarily furloughed before some were called back in?
Hopefully, I mean, even though the president has called some of this data accuracy into question and replaced the head of the Bureau of Labor Statistics, the truth is that these are a lot of dedicated career government workers who have spanned different administrations. There's really no credible evidence that there's anything being doctored or cooked about these numbers. So the expectation is that they will be accurate. Now, to the extent that any of this can be accurate, there was a large annual benchmark revision recently made to jobs data. That's more of a technical adjustment, but it largely has to do with margin of error. The fact that nothing is perfect. I mean, the way that this is gathered is a sample, and then they extrapolate that survey to the broader population. So anytime you're talking about millions and millions of people, I mean, there is some margin of error, but for the most part, we put a lot of trust in this data and rely upon it. The shutdown has definitely called into mind just this idea that investors, policymakers, executives, there's been a void here that this data is not coming in, whether it's jobs, inflation, retail sales. There's been really a freeze on all this information that's normally widely watched.
To expand on your points about the quality of government data, even when this shutdown began, there was this somewhat reliance on private sector data, but a lot of people point out that private sector data isn't done the same way, isn't compiled the same way as government data is, and isn't as extensive. And so, what is the difference between private sector data and government data in terms of what it tells us about the economy?
Yeah, it's interesting you bring that up because ADP, the payment processor, puts together one of the most widely watched, probably the most widely watched private sector jobs estimate. And just this week in the Wall Street Journal, there was a story that they used to feed a lot of this to the Fed, and now there's been some sort of breakdown in communication or relations there. So, not exactly sure what that's about. In recent years, there has been more of a divergence between the public and private data than there used to be. It really just has to do with different sample size. Like ADP is a payment processor, so they're looking at basically what their clients' payrolls look like. So they have a good segment of the market, but it's not entirely comprehensive. So it's all about just sort of sampling, margin of error. Right now, it's kind of all we've got. So it's being watched a little bit more closely than when the official government data comes out. That usually takes center stage. But yeah, there has been definitely a slowdown in the data coming out. And you think about organizations like Bloomberg that are normally all about the economic calendar. The fact that that's been on pause is significant for investors and policymakers.
What have you noticed in terms of how Wall Street has reacted to not having this data available? Has the market kind of been flat and just kind of waiting and seeing?
There hasn't been much reaction to the government shutdown, like whether it's the politics of it or the workforce elements or the fact that data gathering has slowed to a halt. So far, it's been relative calm, but I say that with a grain of salt. This year has been one filled with uncertainty.
Right.
Tariffs would be an obvious example, inflation, what's going on with the job market. So, with this blind spot here of we don't really know what the past month or so has held, we're kind of just remembering the last data points we saw and kind of thinking, well, is that still largely where we're at? Which would be a job market that's weakening, but still in pretty good shape historically speaking. That's what's interesting is that unemployment's not as low as it was a few years ago, but it's still pretty low relative to where it was 10 or 15 years ago. So it's one of these like which way is the wind blowing kind of things. The Fed's trying to get out ahead of any further weakness, and that's a big part of why they're doing these cuts to stimulate the economy, hopefully shore up the job market. Now, inflation has ticked up a little bit. That largely has to do with tariffs. It's still not too bad, but it's not quite as low as the Fed would like. So it's a little bit of a tenuous moment here. We're also coming up on the end of Jerome Powell's term as Fed chair in the next few months. That expires in May, but we should get a read on the proposed successor well before that. So it's just kind of one more thing that's uncertain this year, but there's a lot that we don't know right now about how tariffs will ultimately impact prices and business strategy. The job market's been kind of stuck, that it's a fairly low hire, low fire kind of situation. And a lot of that just has to do with executives waiting to see what happens next on all these fronts. They're reluctant to make any big bets right now.
That's exactly where I wanted to go next because it's not that the situation is more people are being fired. It's just that there's less hiring that's happening. So has that kind of softened the blow of what people may have expected the market reaction to be?
Yeah, I mean, sadly, from a business standpoint, sometimes layoffs are viewed as a good thing because
Right.
like it helps profitability, but it's not a good thing at the individual level. It's also one of those, a depression is when you lose your job, a recession is when your neighbor lose theirs. There's a lot sort of going on beneath the surface. Remember a few years ago, there was that great resignation thing where a ton of people were job hopping, and some of that had to do with the end of the pandemic and all this remote work and people getting called back and the hybrid thing. And there's just been a lot going on in the job market the past few years. Right now, though, people are largely staying put. It's not the best time to switch jobs or look for work. A lot of people are kind of hunkered down right now. Businesses are not sticking their necks too far out either. A lot of times they're leaving vacancies open for longer, or they're trying to fill from within, or they're trying to make do with fewer people. We've seen some notable layoff announcements in tech and media and other sectors, but we haven't seen a tremendous amount of layoffs, but we really haven't seen all that much hiring either. So it's kind of stuck in suspended animation. If you're out of work, sadly, the chances are that that could stretch into long-term unemployment. We've seen a definite rise in the percentage of people out of work for 6 months or more. But many people who have jobs are clinging to them and just feeling like it's a time to stay put, just with all this uncertainty.
I think the new term has been job hugging. People are trying to hold on to work rather than you kind of jump from job to job or find something different. And I do just wonder here to return to our initial discussion point. Obviously, given that the Fed will be making an interest rate decision next week, you said you expect a cut. What are some other things that you expect to be going on behind the scenes in terms of this decision making process? What are the other things that Fed board members may be considering?
There'll be a lot of questions about the path forward. So, do we get another quarter point cut in December? Investors are betting yes. I don't think the Fed is ready to etch that in stone just yet. They're going to talk about data dependency. Hopefully, the shutdown ends soon and we'll have a flood of economic data to sift through between now and December. There'll be questions about Powell's successor. I don't think he's going to give us anything new on that front. In more of a wonky policymaker sense, there may also be some questions about the Fed's bond buying program, the so-called quantitative easing, and when is that going to end? There's some speculation that that will continue to taper down and maybe end by, let's say, spring or mid-year 2026. So that's something that's been pumping liquidity into the system, not as much as we saw a few years ago. The Fed's been sort of slowly dialing back that medicine, which actually, in many respects, is a good thing. It shows the economy's standing on its own 2 feet more. I mean, this is the kind of thing that's more born out of a crisis like the pandemic. And even though it feels like that's been over for a long time from a daily health standpoint, There are definitely some lingering economic issues, whether it's the Fed balance sheet or elevated interest rates, elevated inflation rates. I mean, a lot of this was born out of the COVID pandemic several years ago. So, economically speaking, we're still sort of getting back to normal. But that's something that may come up from sort of an inside baseball standpoint. It also seems likely that Powell might want to wrap up that program before leaving office next spring. So that'll be a return to more classic business as usual for the Fed. But as we know, we keep talking about these unprecedented times. Even if that goes back to normal, well, who's the successor? Is the president going to be leaning on them for lower rates? Is that going to actually stoke inflation in the long run? These are some of the tea leaves that investors are trying to read right now.
Long-term planning is the backbone of investing. So certainly they are looking forward to 2026 and what that'll bring. But for now, Bankrate Senior Industry Analyst Ted Rossman, I appreciate you joining me.
No problem. Thank you.